Welcome back to the South Florida Mortgage Report. It's your hat dude wearing mortgage guy, Billy May, always joined with Capital Partners Mortgage President Craig A. Garcia. He's tanned and rested and back to work now after a couple weeks off with his family and a much needed spring break. Today we've got a special guest for you. We're going to be talking about a special product, and this is really for our real estate referral partners. That this is a product that you probably heard of, but don't know a whole lot more. And we're going to empower you today on this great product. And did you know that there is a product out there where a buyer can purchase a home, make zero monthly mortgage payments for the rest of their life? And most of you realtors out there have never once brought up with a client, and that is the reverse mortgage. And we have today with us, we have Steve Wolf. He is a 40-plus year veteran of reverse mortgage industry. And he's going to tell us about this wonderful product that you can use a reverse mortgage to buy a home with no money out of pocket based on your age and the interest rate and so forth and like that. And he's going to answer all the misnomers and different questions about it. He's going to introduce this product. We're going to go a deep dive into using a reverse mortgage, how to purchase a home. So, Steve, welcome to the South Florida Mortgage Report.
I appreciate it very much. I thought I'd just give you a brief overview of me, really brief, and then a brief overview of the program, and then get into the meat of the matter. I've been doing mortgages since 1971. I've really been at this a long time. I'm a retired FHA DE underwriter. And when I turned 62, and I realized that there was this program out there that hardly anybody knew anything about, I decided to gravitate to this program primarily because of my age and the lack of familiarity of agents and borrowers and people that want to buy a property or people that want to refinance and eliminate their mortgage payment. So I decided to jump in with both feet, and I am now a one-trick pony. I only do reverse mortgages. And I was so infatuated with the program when I realized what it was, I took out a reverse mortgage. I have a reverse mortgage currently. The one thing about reverses is that this program has a terrible reputation. In people's minds, there is a negative connotation to this program, and I'm going to explain why that is. But I try not to even talk about the term reverse mortgage. It is a reverse mortgage. If it walks like a duck and quacks like a duck, it's a duck. And this is a reverse mortgage. But when FHA introduced this program, they renamed the program to try to avoid that negative connotation. And FHA named the program a HECM, HECM, which is a home equity conversion mortgage. That's a mouthful too. I talk to people initially is the fact that this is a deferred interest rate program. And that's exactly what it is. The interest is deferred onto the loan balance. But it sounds better than talking about a reverse mortgage from the get-go. So I use the term HECM or a deferred interest rate program to at least have an initial conversation. Prior to 1989, this program was a predatory loan. This program took advantage of seniors, and I can go into stories about that, but that's not what today is about. Since 1989, Congress and Reagan stepped in, not a political statement, a time statement. They stepped in and created this program for seniors at the age of 62 or older. That's the threshold age on this program, which coincidentally is the entry level for Social Security if a person chooses to do this. It's giving the senior the ability to either buy a home with a reverse mortgage or to retain their existing residence with a reverse mortgage and eliminate the payments for life if they choose to do that. Nothing in life is free. We all know that there is a trade-off. The trade-off on this loan is if the borrower chooses not to make a payment, and most borrowers choose not to make a payment when they're going into a reverse mortgage, the interest that would normally be payable on a forward mortgage is added to the outstanding balance. And so over time, that balance will actually grow. The borrower on a refinance gets access to a proportional amount of their equity, or on a purchase, the amount of their cash investment is based on their age. The youngest of a couple, if there's two, it's the youngest. The borrower still has to make tax and insurance payments, just like they would do if this property was free and clear. So taxes, insurance, and HOA um, have to continue to be paid. 90% of the reverse mortgages in the United States are the HECM, the FHA product. Um, Prior to when the program came about, the program initially did not involve any credit or income qualifying at all. It was strictly based on equity back in the 80s when this program started. So there was no credit test, there was no income test. You fogged a mirror. If you had the right equity, you got the loan. Also, the math on the program, how this works, was successful enough that FHA, from 1989, the program started to develop. And in 2009, FHA allowed us to plug in the purchase part of this loan, where a borrower can actually purchase a home with a reverse mortgage. In 2008, when the world collapsed, property values imploded, there was a significant amount of foreclosures that took place in general because property values went down so dramatically, but particularly on the HECM product because there is no escrowing on this account since there's no payments. So a borrower could not accumulate by way of an escrow account the payment for their taxes and insurance. And most of the foreclosures came about because borrowers could not make their real estate tax payments. And that's what created the issue and the foreclosures that took place in the past because of the fact the borrowers did not have enough income to even pay their real estate taxes. So in 2015, FHA inserted a new regulation called a financial assessment that we have to look at the borrower's credit. We have to look at the borrower's income, not as detailed as we would have to do on a forward mortgage. There is no credit scoring, there's no debt to income ratios, but we have to do something called a financial assessment, which is looking at the borrower's debt load, because there's going to be no mortgage payment, but we still have to look at their other debt load, car payments, credit cards, taxes, insurance. And the system requires us to make a financial assessment on credit and income so these borrowers do not get in trouble going forward. Because again, there is no escrow account to accumulate money for taxes and insurance. Back in the heyday of these loans in 2001, our interest rates on reverses were 3%. Today, our interest rate on reverses are 6.5%. It's a huge factor in determining the equity that's required on either a purchase or the ability to refinance and eliminate a mortgage payment. Today, our loan to value, whether it's a purchase or whether it is a refinance, are between 30 and 40%. It's a function of the date of birth of the youngest borrower, and if it's a purchase, a function of the interest rate. This product was growing at about 47% per year until 2023 when the interest rate started to tick, tip up or go up. Okay. So as interest rates move up, it is harder to get or more difficult or more equity is needed on a reverse. Does that make sense, guys?
It it does. But let me just back up a second. Said so. You said up until 2023, the reverse mortgage product was growing 23%, meaning annually since they've made these
year
changes in
year by
2008,
year by
2009,
year,
2006?
year by
Year by
year,
year. Right,
it was growing. And
right.
what's really dampened it right now is what's dampening real estate in general are the interest rates.
Yeah.
And interest rates play a huge part of the calculations because it's date of birth, purchase price, and then interest rates on a purchase. On a refinance, it's date of birth, property value, existing loan balance that we try to pay off. And all of those get factored into an online system that's encrypted that we have directly to FHA, and it gives us the answers back in terms of what the down payment or cash needs to be on a purchase, or on a refinance, it tells us the equity position that's either there or not there on a refinance type of situation. Um, I thought what I would also do before we get into some examples is run through some misconceptions that people have about this loan, because I
Yeah.
talk to people every day, and whether it's agents, whether it's borrowers, there's a misconception about some of the things on this loan. And if I could just hit those briefly, I think that would help.
Oh,
The first,
absolutely,
yeah,
because
okay,
like, I mean, you've already gone through kind of like, what's transpired the past 40 years now. It's grown, it's changed, and the regulatory efforts that have been implemented to help us get to where we are today.
right,
But as you know, perception is everything, and there is that misconception out there with a lot of people, I believe, that reverse mortgage is bad.
I
They
know.
don't realize that it's a great product, and it's for the right individual. But yes,
Right.
if you can clear up some of these
Yeah.
misconceptions, that'd be
And I
great.
think for a lot of people, perception ends up being their truth. That is, if they perceive something, they just presume that's true. And all I try to do when I talk to people is not try to convince them about the product, but just to make sure they don't have the wrong misconception. The first thing that people constantly say is, I don't want to do this loan because the bank will own the property at the end. That is, people believe that this loan will revert at some point in time back to the bank or FHA. That is totally incorrect. The title stays with the borrower all the way through. If the borrower sells the property, they sell it, it's an FHA loan, no prepayment penalty, they pay off the balance plus the accrued interest, they get the proceeds, life goes on. If the last borrower passes away, the property will pass to his or her estate. The estate then has the ability to either sell the property, pay off the loan and keep the proceeds, refinance the property if they want to keep the property, or they can, if they choose, walk away from the transaction, stick their head in the sand, and it's no harm, no foul. But the estate then is walking away generally from a significant amount of equity. Because if this
Yeah.
loan starts out to be a 40% loan to value, that means there's 60% equity left in the property. But in no way does this property revert to the bank or to FHA or to the lender. It reverts to the estate. The estate then makes the choice, if that makes sense. Okay.
So the
But
idea that, hey, I'm not going to leave my kids anything regarding the property, it's not true.
that's not true. Okay. I've been doing this a long time. The depending on how long the borrower is in the property, how long the interest is being added to the loan balance, what the property is worth down the road is really the determining factor. But the estate is in line to either sell, refinance, and take the proceeds and go forward. This is not a predatory loan. Prior to FHA getting involved, it was. I'm the first one to admit that. There's horror stories about what happened to people that had reverses prior to FHA's involvement. But bad news dies slowly, guys. And the bad news prior to 1989 lives on. I deal with that every day. The cost of this loan, the closing cost on these loans, either refinancing or on a purchase, are higher than a traditional loan. There's no question that the cost on these loans is something that catches people's attention. But I always look at the cost versus the benefit. To get into a loan that you have no mortgage payments for the rest of your life, to get into a loan that has heavy duty consumer protections built in, to get into a loan that doesn't have heavy duty credit scoring, to get into a loan that doesn't have heavy duty debt to income ratios. I don't believe there is another loan out there that has those features. No credit scoring, no debt to income ratio, and no payments. That the benefits versus the cost, I think, easily balance themselves out. And before you jump into the question, I'm closing a loan this next week where the closing cost on the loan are $12,000. Okay. That's certainly higher than a traditional loan. The borrower is eliminating a payment of $1,000 a month. It's a refinance. I'm not the smartest guy in the world with math, but the recovery period of those closing costs are 12 months. And if the borrower plans to be in this property for a long time, the closing cost will certainly justify the benefit.
Yeah, I've said for a long time that I don't know of any other financial product that does what a reverse mortgage can do for somebody.
I,
It can really, really be a tremendous thing.
right.
Um, another misconception, Steve, is can you get kicked out of the house?
That's the next point that I was going to make. Okay.
Yeah,
The next point on my list is there is a perception that at some point in time, on a refinance, if you use up the money, or on a purchase, somebody's going to be come knocking on the door and saying, it's time for you to leave. Okay. That was what happened prior to 1989 before FHA got involved. As long as a borrower makes their tax payments, real estate tax payments, they make their homeowners insurance payments, as long as they make their HOI or HOA payments, there is no way that the borrower will ever be forced to leave the property. That's not that the program is structured to allow them to remain in the property the rest of their lives. But even on a free and clear property, if you don't pay your property taxes, sooner or later down the road, somebody's going to take your property from you. Okay. So just because you have a reverse, that doesn't change that. As long as you pay your taxes, as long as you pay your insurance, as long as you pay your HOA fees, no one is ever going to be asked to leave the property. The other thing is that people think this loan is a loan of last resort. It's only for the perception is it's only for people that are in trouble. It's
right.
completely, quote unquote, the reverse. Statistically, 75% of these loans in the United States are done for people that are high net worth people, credit worthy people that want to manage the equity in their home and don't want a mortgage payment. We are able to help people that are struggling, but the usage of this loan is way over half. It's 75% of the people that use this loan are people that want this loan to manage their equity better in the future. This loan also has a loan balance that increases over time because the interest is going to accrue on the outstanding balance. That's not necessarily so. The reverse that I have, I make monthly payments occasionally. By making monthly payments, I stop the loan balance from going up. So these loans have payments that are optional. If a person chooses not to make a payment, interest is going to accrue on the outstanding balance. If a person is used to making a payment and wants to make a payment, they may. So I make payments like 9 months of the year. When I get close to the holidays, I want to buy my grandkids Christmas presents and stuff. I don't make a payment. Okay. So I can go in and out of the payment mode, but the loan balance does not have to increase over time. It's a choice that the borrowers make by either making a payment or not. And the last comment I have about the misconceptions or myths is that this loan is complicated. It is different than a traditional forward loan. There's no question about it. The terminologies are different. The loan to values that we're all used to using in the forward world really don't work on the reverse world because it's based on a person's age. So I think this is the type of loan that can be complicated unless you plug into somebody that can actually guide you through this transaction. Not that you have to have your hand held all the way, but people need help. The terminologies are different. For some reason, FHA doesn't call an appraisal on a reverse. It's called a max claim. Now, why FHA renames what we deal with every day differently, I don't know. It does complicate it.
Yeah.
The loan amount that we can make is called a principal limit. I would just prefer to have it be called a loan, the loan you can get. But the terminologies are different. There's no question about it. I thought I would focus for a second, unless you guys want to jump in with a question about what's available on the purchase side, because I think that's the piece that, at least in my marketplace, agents just don't even understand or believe that there's a product out there like this product. Um, for example, on a $500,000 transaction, the cash to close is about $335,000. That equates to about a 65% cash investment mathematically. Okay. That's just what it is. FHA has allowed a seller to pay up to 6% of the closing cost on this, like they do a traditional loan.
Mhm.
When I bought my house with a reverse, I did not negotiate the purchase price. I paid the seller what they wanted for the property, and I had the seller pay my closing cost. On this $500,000 example, the closing costs are about $30,000. Okay. By the time you have FHA mortgage insurance and everything else, a seller can pay all of those, which reduces the cash outlay significantly. So
Right.
it's a negotiating strategy, but a seller can pay up to 6% of the excessive closing cost, and they're high, that minimizes the cash investment on a purchase. I did an example the other day for another presentation I was doing, a live CE class in Arizona. Just for an example, for a 64-year-old person buying a $300,000 home, and by the way, this product is designed as an alternative to an all cash purchase. You can see somebody that wants to put down 10 or 20% is not going to be doing a reverse
Right.
because it's a higher down. But for a 64-year-old person buying a $300,000 home, they only needed 200. This is without seller concessions. They needed $219,000, which meant if they were planning on spending $300,000 for cash and they only needed 219, they were able to keep $81,000 in the bank for future expenses, buy furniture, take trips, do
Okay.
whatever, but they did not have to use that 81,000. The other example, which I think is really important, if they still wanted to put down 300,000 with a reverse, we can take them up to $420,000 purchase price for the same $300,000 cash investment. So we can either minimize their cash out of pocket or maximize their purchase price. And I think that is significant.
Yeah,
I
the way you said that, and the way I would think about it is, imagine if you're an agent, you're working with a buyer, and they just sold a house and they're looking to buy a property for cash. Like you said, they got $300,000. Well, now if they understand that this is an option, you really can really widen the amount of properties that they could look at, because they could really look at $300,000 properties up to $400,000 properties and still have no mortgage payment, which is kind of what they were trying to get into by paying
Right.
cash.
Mathematically, you're right. That's a 40% increase in their purchase price that they
Right.
can negotiate by using that same $300,000 and have no
It's a lot
mortgage.
more options that a buyer now can look at for the lifestyle that they want to lead, making this move. That could be really big.
I know.
Oh, yeah.
I think it's huge.
Yeah.
It's huge too in our marketplace, Steve, because we're based, although we land over Florida, we're based in South Florida, very expensive to live. And what you're saying is now that you're explaining it to me, it's all making sense because you're empowering borrowers. And you said that, I mean, what, 75% of your borrowers are people that are really, good net worth people. They're trying to manage their funds, like you said yourself. You can make payments. You make payments on yours 9 months out of the year, but hey, Christmas comes time. If you want to not make a payment, it empowers you to take control of your finances. And down here, as we said, it's an expensive place to buy, and you get somebody, maybe they only have, let's say, only $300,000, and maybe they don't want to buy a $300,000 condo. Maybe they want to buy something a little more. They can maximize that, and even when they do buy the property and they do close, the cool thing about it too is that you've alluded to is that the revert. I mean, you're paying no mortgage, but it will grow over time. Like they could re-access equity on the property, correct?
Yeah, yeah, and I'll spend a second on that too, when the time comes. But I'm gonna flip over to refinancing if I could really quickly.
Sure.
Um, we can come back to purchases anytime that you want, but on a refinance, I think it's a great tool for agents to reconnect with people that they have potentially sold properties to in the past that are older folks over the age of 62 and reconnect with them. And connections are what it's all about, is to keep those connections. Reconnect with those folks and ask them, have they ever considered looking at a HECM or a deferred interest rate loan that would potentially eliminate their existing forward mortgage? And as property values increase and as people get older, those are the factors that are key in my world is value of the property based on appreciation and ages of people. We never get any younger. We're always getting older. And we have the ability to go back to people that have forward loans. And by the way, we go back to people that have reverses, and I'll talk about that in just a second. But we can go back to people that have forward mortgages and we can work the math and potentially eliminate their existing mortgage. And depending on the value of their home, if there are extra proceeds available after paying off their existing loan, we can either offer them kind of a lump sum payment that they could get at closing. We could offer them what's called tenure, TENURE, which are monthly income coming to them for the rest of their life, just like Social Security. It's deposited into their bank account, direct deposit. Or we could offer them um, a line of credit that they could access at a later point in time. And the interesting thing about the line of credit option on a refinance is that credit line that's unused grows at 0.5% higher than the interest rate that the loan balance is being accrued on. So if the loan balance is going up by 6%, because that's the current rate, the line of credit's going to grow at 6.5%. The line of credit is growing, and there's some financial advisors that I work with that they cannot believe, well, they do now. They they were shocked that they could offer their customers, a line of credit that would actually grow. So if the line of credit that's offered is $100,000, at the end of the year, that line of credit has grown to $106,000 that they could access at a later point in time. The other thing about if a person has a HECM, a reverse, as interest rates decrease, and they will in time, hopefully, and as property values keep going back up, those people that have existing HECMs, we can refinance them and do what's called a HECM to HECM refinance and give them more money. They can grab the golden ring another time. And back when rates were in the 3% level, I was refinancing about 80% of the people that I had done HECMs for previously because we were able to offer them more money. It's a hard concept to initially grasp, but when you grasp the fact that you can refinance a forward and eliminate your payment, or refinance a HECM and grab the golden ring another time, it's a phenomenal option to have out there. And that goes with a purchase or it goes with a refinance, the ability to refinance in the future as property values grow and as a person age because age, the older we are, the loan to values improve. It's easier. Okay. If you're 90, you probably wouldn't want to be doing this stuff at that age. But if you're 90, you're going to get a better loan to value or a lower down payment on a purchase than if you're 62. It is age discriminatory in reverse. The older, the better. And the other thing I'd like to mention on a refinance, it doesn't really apply too much to a purchase, but on a refinance, if a person is totally upside down in their world, that is, they have late mortgage payments, they are struggling with their debt load, we have the ability, even though there's a financial assessment, we have the ability to structure something called a LESA, LESA, life expectancy set aside. That allows us to, at closing from their proceeds, set up an account. From that account, we as the lender pay their real estate taxes when they come due. We pay their homeowners insurance when those premiums come due. It's not penalizing them, but it is setting up an escrow account at closing up front. Now, keep in mind, they're not making any mortgage payments, so they can't contribute to that monthly. But we set that up, and out of that LESA account, we pay taxes and insurance. For some older folks, that simplifies their life, even if they don't have credit issues, because they don't have to worry about paying their taxes and insurance. It's paid for them out of this account. And the last thing I want to mention on the LESA account is that the amount of money that's in that account grows at the same percentage that the credit line grows. So the LESA account will grow currently at 6.5% to take into consideration taxes and insurance probably going up in the future. But the amount of the LESA disbursements, they are not part of the loan balance until they're applied to pay the taxes and to pay the insurance. So, and if you look at it this way, if they have the right equity, it's not a penalty, it's a facilitation of paying their taxes and insurance on their behalf. The LESA account, particularly for older folks that struggle with paying their bills, their taxes and insurance, the last thing an older couple wants to do is not pay their homeowners insurance, right? Because they have a loss, they have no insurance, or they don't pay their taxes and they have the tax man come knocking at their door. I have a lot of children of seniors that want the LESA account to be put in place to assure the taxes and insurance are paid for their parents, if that makes sense.
Yeah, that definitely makes sense, and you're clearing up a lot of misconceptions about the. I guess we don't want to say reverse. We want to call it the heck'em, right?
Or deferred interest. But it is a reverse. It is a reverse.
Right.
And I don't hide that from the people, but if
Sure.
I can warm them up, or if you all can warm them up to
Yeah.
the HECM term or deferred interest, and show them the advantages before you say the word reverse and their eyes roll to the top of their head and they don't even want to hear the story.
No, I think
People,
I think it's great, and it's getting back to the Heckam. I know you were talking about the reverse refund. It's getting back to the Heckam purchase. One of the things that, if we're the realtors who are watching and listening to this, like, what are some of the kind of trigger words or questions when they're talking to their past clients? Because you said, hey, if you reach out to your past clients, what are something that maybe when they're reaching out to their past clients, that maybe their clients are telling them, or questions maybe they should ask them, like, hey, I'm looking to downsize one. Is there certain maybe questions or something that the agents can be asking their past clients?
yeah, the only thing I constantly, talk about is the fact of exposing customers, potential customers, to options. Okay. Are you aware that there is a program out there that will eliminate your house payment for life? You don't have to say, are you aware that there's reverse mortgages? That
Right.
term turns them sideways. But are you aware of that there is a program especially designed for seniors, particularly designed for you by the federal government, that allows you an option of not having a house payment for the rest of your life? Are you aware that there is a program that will allow you to buy a house potentially 40% higher than the home you could buy with an all cash purchase?
That's a key one right there.
Yeah, I think it is. And I think the whole key is, are you aware of this option?
Yeah.
And not saying the word reverse initially, not saying that term, because I can tell you, after doing this for so long, I learned if you say reverse in the first conversation,
Yep.
they're going to immediately say, well, my next door neighbor says they're a bad deal. And,
Oh yeah.
and you say, what particularly the next door neighbors say, there's never a specific answer. It's just that they're a bad deal. So as long the further into the conversation you can get about the fact that you can expand your purchase amount, you can have a loan that is specifically designed by the federal government for seniors, that eliminates your payment for life if you want to not make a payment. There's a program out there that will do that. If you are feeling like your credit, you don't, you want to do a loan, but you've got some credit issues that really are stopping you from getting any type of loan, because I don't know in your world in South Florida, but here, if you got a defective credit score, you're out of luck. You know, you're
Yeah,
out of luck. Now, there may be loans out there with down payments that will be more easier with a credit score issue, but this loan doesn't have a credit score issue. It doesn't have a debt to income ratio. The payments are optional, and you can expand your purchase power. Those are powerful conversation starters with borrowers, I think. I think they are.
totally.
I think the
Increase your
key is
purchase power by
option.
40%
Yeah,
with
I
no
think
more monthly payment.
the key is option. Not I don't try to sell this product.
Yeah.
I just try to educate people to the options that are available, and it will either sell itself or it won't.
And one thing that I will throw in here that I think is a potentially a misconception too regarding a purchase is that this is something that has to take a long time. And I can tell you that I know that we've closed one, purchase loan inside of 30 days. So it doesn't have to, it's not some different type of time frame necessarily than traditional financing, right?
Particularly, and if us on the lending side prep the borrower and the agent to
Yes.
what the process is on a reverse, you can kind of go through the pre-qualification process and get a lot of the stuff moved to the front end, which one of the things that can get moved to the front end is the counseling. Um, all of these loans, whether it's a refinance or a purchase, require counseling. It's a third party counseling that's done by an FHA nonprofit entity. The counselors are there to answer questions that the borrower may have. Now, if we as lenders have done our job, there's not a lot of questions that the counselor is going to be asked, but the counselors are there. They can answer the borrower's questions. The counselors are also there primarily for the borrower's safety and security. And what I mean is if a borrower wants to do a reverse and is not mentally competent, we cannot do a reverse without getting involved with conservatorships or power of attorneys or whatever. So when my mom was doing a reverse, she had early stages of Alzheimer's. We wanted to keep her in the house. She did not want to move out of the house. So we did a reverse mortgage. We called the counseling agency. I was on the other line. The counselor starts into the process. Mrs. Wolf, do you have any questions? And my mom's initial reaction was, and she was kind of getting obstinate in her old age. She goes, I don't know who you are, and I don't know why I'm on this phone call. Obviously, the counselor knew right away that my mom needed family help. And we were able to do a power of attorney, and we got her a reverse mortgage. So the counselors are there for one of three reasons. Number one, federal law. Enough said. We can't get by it. Number two, a lot of lenders don't understand this program, and they expect the counselors to explain it, which is not a good approach because the lender should be explaining it. And the third is the counselor needs to make a determination whether the borrower has engaged in the conversation and appears to be mentally competent. The counselor will say such things as, do you understand that you will still have to pay your taxes and insurance if you do this loan? Do you understand there will be an appraisal of the property to protect you? So it's not like it's an extensive session where there's a test at the end. If I prepare my borrowers properly, it's a phone call that takes about maybe 20 minutes, 15 to 20 minutes, depending on any questions that the borrower has. The counselors require payment to be paid upfront. Lenders cannot pay for that counseling fee. The counseling fee is in the area of $150 to $165. That is the fee that has to be paid to the counselor to get a counseling certificate. The key for us to prep our borrowers properly is that is not property specific. It is borrower specific, which means on a purchase, if the borrower has not selected a property, the counseling can still be done. The counseling certificate is valid for 6 months. It doesn't require that the borrower immediately do a HECM, reverse mortgage, deferred interest, whatever we want to call it. But getting the counseling is important because from a lender's standpoint, you guys may know this or you may not. We can't order an appraisal. We're not supposed to order credit reports. We're not supposed to engage in any action that has a fee involved with it until that borrower has been counseled. So if an agent sells a property, does their home inspection, and then tells the borrower about the counseling, or if you're working with a lender that doesn't explain this up front, you go through the contract signed, home inspection, renegotiation on repairs, and all of a sudden you want to start a loan, the borrower's got to be counseled before we could even start the transaction. So if we do a good job from the lender standpoint, suggest that the counseling be done up front because it's good for 6 months. Understanding it's not property specific, and also explain to the borrower or to the agent the documentation that's required on these loans is a little bit different than is required on a forward loan. It's not harder, it's just different. And my typical closing, because I do resale as well as wholesale, my typical closing on a purchase, because I prep everybody properly, is about 3 to 4 weeks.
Yeah, I mean that's quick. I mean, boy,
It is
like you
quick,
said,
but
Craig,
I
we
do
no.
what I suggest people do up front, just like a pre-qualification that you would do on a forward loan. I suggest that they get counsel, and I give them a list of the documentation that they need to be prepared to give us, which is standard. It's not like lender specific, it's industry specific. And I can go through some of the things that are different if you want me to on the documentation, or we can lay off of that. I'm not trying to drill down any more than you want me to.
Yeah, I think over kind of what keep it high level. I don't think we don't. I don't. What about you, Craig?
Yeah, no, I mean, I guess let's go this direction instead. I mean, Steve, who's a who's this not a good product for?
It's not a good product for people that don't have significant equity. If somebody
Okay.
has 20% down and wants to buy a house, don't even bring it up.
Yeah.
Okay. So they
Right.
have to have good equity. They also have to plan to be in this house and not try to buy a house and flip it. Because who wants to pay these closing costs for a
Right.
loan that you don't have for a long period of time? So
Yep.
I look at it that the people that don't fit this model are people that don't have the cash or the equity and don't plan to be in the house for at least 2 years. I think other than that, I mean,
Okay.
by the way, if somebody gets a home and wants to sell it immediately because something happens, they can do that. It's an FHA
Sure.
loan, but they're going to have to stomach or absorb the closing costs that are really designed for a long-term type of situation. Um, so I think I think there's a selective group of people that it's not designed for are people that don't have the equity, cut and cut and dry. They don't have the equity or the down, or they don't plan to live in the property for at least 2 years.
Great.
Other than
Yeah.
that, I think it's something that people might like to see as an option.
If you're an agent, we're trying to tell our agents, hey, is there a single conversation starter or something, to say, hey, if they're over 62, this might be an option. And that's just something that it's just so new to the agents. And that's where you want to overcome that. Hey, not the reverse. It's, this is something that's new and unique. And we're trying to empower them to be able to talk to their potential clients, or like I
Yeah,
said, their past clients about something that's option.
right.
So
I think
let's try
my
to,
advice to an agent would be to not try to get into the weeds on this loan. That
yeah.
is to get them to a lender, to get them to you guys. Okay. But I know there's got to be that initial conversation because that's where the initial point of contact comes from. It comes from the agent and the potential borrower. I know I come back to the same verbiage is, are you aware that there's a specific program designed for you, senior, that will offer you the option to make payments in the future if you'd like, or to not make payments, and the ability to expand your horizon onto the purchase price. And I think if a borrower then engages in that, tell me more. My advice is that that agent probably wants to get them immediately to you guys. Because if the agent starts to drill down on this product, I don't believe that the conversation is going to go in the right direction because the borrower is going to start asking questions that the agent does not have the answers to. And every time it's, I don't know, I've got to get back to you. I think that's a negative in the mind of the potential purchaser if this agent opens the door too wide and tries to drill down too deep. That's my advice is to stay on, hit the top of the waves, talk about the options, no payment, expand your purchase price, and get them to somebody that can answer these questions and not try to sell them the product. Try to
Yeah.
expose them to the product and
Right.
then answer their questions. I look at my job as an educational job. If I do a good job of educating, I want to help with the loan. That's where we're all about, the loan. But you've
Sure.
got to educate first. And it's unlike everybody understands a traditional loan. Everybody understands a 30-year fixed rate loan. They were brought up with that. They know the down payment parameters. They know the payment's not going to change unless their taxes and insurance goes up. So an agent can very well talk about interest rates, those type of things on a forward loan because they know it. They grew up with it. This loan it's not hard, but it's different. So my advice is the agents not to go deep on this product.
And Steve, before we go now, one of the big opportunities down here, which might be a sore spot in this particular conversation, is condos.
I wanted to bring that up if you didn't. So,
Yeah. So obviously, this being this particular product that we've been talking about, the HECM, being an FHA loan, most condos in Florida are not eligible to take advantage of this because most of I mean, primarily, even maybe for different reasons, but I would say the biggest one is most condos in Florida have leasing restrictions, which are, if anybody besides the owner of the condo unit has a say in who the unit can get rented to, then that's considered a leasing restriction. And FHA, you can't do FHA loans in projects like that, and that's most condos down here.
right.
So I don't
And
know.
there's also issues on reserves,
Well,
homeowners
sure.
insurance. There's a whole area of concerns. We do have the ability to do single unit approvals on the FHA product, but they're tough on condos. I'm not minimizing that because
Sure.
there's an analyzation that's done on the issues that
Yep.
we're talking about right now. There is
Yep.
a market out there for non-FHAs called proprietary or conventional loans, but
Okay.
those are also going to look at the condo project and is going to
Okay.
look at those issues. So I don't have a cure-all on the condos.
Sure.
I
Sure.
don't have that. And so one of the things that I do right up front is when I help you all or talk to people is if it is a condo, we've got to be careful because it's unlike a PUD. It's unlike a
Yep.
single family. We have to go down a little rabbit hole on these condos. And I wish it wasn't that way, but it is.
We know all about the rabbit hole.
I know. I
We
know
we live in the rabbit
probably
hole every day.
you know it more
Yeah.
in South Florida than probably anywhere else. I do understand that. But
Yeah.
the HECM product is going to look at the condo. The proprietary product is going to look at the condo too. I
But
don't have
there is an option for borrowers. There is a program for a condo that's not an FHA approved condo, even if you don't get it, even if you're not talking about a single unit approval exception on an FHA, but the proprietary model would be that would be the option to look at for
right.
somebody.
And I do think, and I'm not trying to dismiss me from that conversation, but on the
Yep.
proprietary, each lender creates their own guidelines. And I
Right.
think that there are lenders on the proprietary side that want that business more than other lenders, and their guidelines are easier. And so
Got it.
I don't dismiss those from the very beginning, but I think if you can find a
Sure.
lender that does proprietary reverses that
Yep.
is easier on the condos, make them your
Right.
best friend.
Sure. Sure.
Because
Good.
HECMs, we don't have the ability to bob and weave on the HECM. We got to meet FHA's criteria.
Yeah. Understood.
The other
Understood.
thing on the proprietary, which I just will throw out there, is that the age restrictions are easier. It's general now in the proprietary that 55 years of age is an entry level on a lot of proprietary loans. So they've
Okay.
lowered the threshold on that. And at times, they're lowering the threshold and they're reducing the cash investment, but the closing costs are higher on a proprietary. So it's balancing all those things out. But if you can find a lender on a proprietary that has flexibility on the condos, make them your best friend. I can't do
Yeah.
that on the HECM.
Understood. Bill, any other questions for Steve?
No, I mean, just a lot of information. I think,
May I tell you about the best
sure.
reverse I've done? And then we can close this.
Oh, sure.
Sure.
Yeah. I love to hear
Yeah.
that.
It's the best reverse I've actually done. It's a refinance because this was done years ago, but
Yeah.
I occasionally, and this is not normal, but I occasionally am asked to speak at church groups. The reason that I'm asked to talk at church groups is that generally their audience historically are older people. Now, I don't go into the church service. I don't mean that. I mean, like a Wednesday night, they have a meeting.
Sure.
I went in and gave a half an hour presentation to a group of people. All of them were seniors. And at the end, this older lady came up and said, I want to do this loan. And by the way, guys, this is not an instant impulse purchase deal. Most people think about doing these loans. This lady
Sure.
came up and said, I want to do this loan. And I said, good. I said, we got to sit down. I've got to do some calculations for you. I want to make sure you've got the proper equity. She goes, well, my house is free and clear. I know I have the right equity. And I said, okay, um, let's let's go over here away from the group. Let me just chat with you. And she said, do you need to know what I'm going to do with the money that I'm going to get? And I said, it's none of my business, ma'am. It's tax-free money. It's your equity. You do not have to tell anybody what you're going to do with this money. She goes, but I want to tell you. And so she got a little gleam in her eye and she said, I want to do this loan and I'm going to prepay tuition for my granddaughter to college. I want to give this to my granddaughter. I don't want to leave the money when I pass on and leave her money. I want to prepay 4 years of college tuition for her and give that to her as a gift. Now that's pretty
Wow.
cool.
It's really cool.
That's a beautiful story.
It is.
Yeah.
And she did it. She did it. And she generated enough funds. And it wasn't my business where she goes to college, whether it's a junior college, a trade
Yeah.
school, that it's her money, it's tax free.
Yeah.
But she wanted to tell me what she
Yeah.
was going to do with the money. And I said, that is the coolest thing that I've ever
That is
heard
really cool.
in
Oh, yeah.
my world. And she did it.
That's awesome.
Yeah. Oh, that's great. Yeah, for sure. And there's just like you said, they can use it for anything, but for her to share that with you and to make an impact. I mean, you think about her granddaughter for the rest of her life. She's remember, hey, my grandmother paid for my college, to go
Right.
to
And
school.
I think the alternative was when she passed away, the estate was going to give the granddaughter.
Yeah.
But
Sure.
she wanted to see the look on her granddaughter's face when she gave this to her.
Absolutely.
She
No,
wanted to be in the room and say, here you go. And
yeah,
she did it. And that's probably the, that I know of, kind of
That's really cool.
the
it is
best
cool.
story that I actually know of. A lot of people don't share it. They just take the money and they go.
Right.
But this lady,
And honestly, with the way that the tuition cost increases, if she prepaid it early, she probably saved her estate some money rather than waiting and paying it out of the estate at the end.
I know, and I
That's
think,
true.
and I know that at least I know from my daughter and granddaughter, if you prepay, you get a discount,
Oh yeah,
Yes, that's right.
it's
and
huge.
you don't get subjected to the increases that they constantly are doing. So
I can tell you that the increase, the tuition has been increasing by more than 6.5% a year.
I agree.
That's right.
But I think
Right.
if you,
Especially in Florida.
at least in this world, if you prepay, you've got a deal. You've got
Yeah.
a deal.
That's a great point in and of itself. I mean, in Florida, we have a wonderful prepaid college program for state
It's amazing.
universities.
Yeah.
Yeah.
So that's because on the outline that you gentlemen gave to me, you kind of said at the end, give a
Yep.
story of maybe
That's a good one.
the best one that you've done, and I don't have to think about that one. That is the best. I don't know how
Oh,
I
wow.
That's
can
awesome.
top that one.
Good stuff.
Well, Steve, this has been great. I really appreciate you taking the time, and thanks for being a great partner with us and helping us deliver these types of options to the clients. It's really been
I'm always
cool.
here.
And we've
I'm always here to interface with you, to answer
Yep.
your questions. I think you've dealt with me. You know I'm responsive, email wise. I like to engage people on the phone if people want to call
Sure.
me. I like to talk about the product because I believe it. I have it.
Yeah.
Yeah. Yeah. Great stuff. All right.
Well, thank you, Steve. We'll be talking soon, and thank you for spending the time with us on the program here today. And this has been great.
I appreciate the opportunity. Thanks, guys.
Thanks again, Steve. Have a great
Bye
day.
bye.
Thank you.
Take care.
Okay. Take care. All right.
That was
Great
good.
stuff. Yeah. Yeah.
Yeah.
Really, 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 really good stuff. So, uh, that was a nice, that, I mean, his example too is great.
What a story. Yeah. No, that's a very special thing to be able to do, and I'm sure that made it meant the world to her to be able to do that just as much as it meant to the her granddaughter to be able to go to school on her
Yeah.
result of that gift. So very nice.
I like the part, where you said, was trying to drill down on the purchase part of it.
Yeah.
Hey, you got X amount of liquid funds to buy. You could utilize those funds instead of paying something in cash. Let's just use the down payment, get you to the house you really, really want. And,
Yeah, I think if you're an agent and you realize, okay, I know what this person's working with, and if you're aware enough of this program, and now you go, okay, I know these neighborhoods that they could spend that kind of money in, and I know that
right,
I can find something, but I know if I go to these other neighborhoods
right,
that they would need a little bit more, that it's
right,
going to knock their socks off. And the idea
right.
that they might be able to do that
Yeah.
and not have any payment.
And keep more of your liquid funds.
Right. I'm just thinking of from the standpoint of somebody who's a cash buyer,
Yeah, yeah, yeah.
that's coming in not looking to spend any money and not have any payment. And
Right,
now they can just expand the
right.
lifestyle opportunities that they can look at for these people
Yeah,
without changing anything about their budget.
yeah.
Same amount of money out of
No,
pocket, no same amount of money monthly, no payment.
yeah,
So
right.
I think that's definitely
That's the
I
hook
think
for the agents.
Yeah, I think that agents they're gonna like that
Yeah,
part. That's
yeah,
that's
yeah.
that's that's great.
So,
Um,
good stuff. Now that we're gonna segue to rates, right, Craig? Kinda
yes.
kinda all
So
over the map. I mean, the survey comes out. I mean, we know that it's the survey's kinda old data, but I mean, really realistically, we're probably I don't know, I priced it alone yesterday. We were still like around, 6.375, almost near 6 and a quarter. You got to pay a little bit of discount to get there, but I mean, really stuff's closer to like 6.4, 6.5, really, for the most part.
yeah, and the I'd say rates probably saw their worst a few weeks ago.
Yeah,
They've been getting a little bit better.
yeah,
Maybe the fear about what's going on in the Middle East is maybe the worst is behind us, but we don't know that yet. And
yeah,
so I think
yeah,
if depending on what transpires from here, if they
right.
can make further progress and the oil can flow and that can get contained, then the inflation fears get reduced and rates can stay where they are, maybe come down. So
It was a little
that's what we're
chaotic this
hopeful.
week. We had some reprices this week, with a couple more negative reprices. I think, we had, I think, a
Yep.
positive reprice during the day, so it's
Yep.
just kind of been all over the map. So,
Still not
but
stopping people. I mean, we're still the applications have been coming in.
yes,
It's been busy. People have been active.
yeah,
Deals have been getting put together, so it's definitely been interesting to see the result. What's happening while all of this is kind of going on, all this turmoil. So
yeah,
pretty
yeah. I
pretty
mean,
resilient.
yeah, yeah, I'm busy. I just picked up another contract at another part of the state up in the northern part of Florida. I mean, it's
Yep.
still busy. There's still activity. I'm seeing a lot of there is buyer activity. Agents are showing properties out there. So there's I think that spring home buying season. It's upon us
Yep.
now. We're in April now, right? Got to buy now. So a lot of good stuff going on.
Absolutely, sir.
Very
Well,
cool.
this has been a good one today. It was a good
Yes,
session, Mr. Wolf,
very
and
informative.
I think that people are going to get some eye opening tidbits out of that interview. So I think that'll be good.
Yes, I agree. I concur wholeheartedly. All right, sir. You have a great weekend, and we'll see you at the
At the
closing table.
closing table. Yes, sir.
Even if it's a heck'em, we're going to see it at the closing table. So
Even if you're not going to have a payment, we'll see you at the closing
even
table.
if, all right, sounds good, Craig.
All right, bud. See
Take
ya.
care. Bye now.